The Reserve Bank of Australia is an independent bank, however is accountable to the Commonwealth for its actions. Since 1993, one of the main objectives of the RBA has been to manage the inflation rate as managed by the Consumer Price Index. Meeting on the first Tuesday of the calendar month, the RBA made a historic move in May 2022, lifting the interest rate. Subsequent to the announcement of the change in interest rate, the big four banks in Australia, being the Commonwealth Bank, NAB, ANZ and Suncorp, all lifted their individual rates as well. The increase in interest rates by the RBA will have a follow-on effect through the banks to mortgage holders on variable interest rates. Most noticeably, the increase in rates will see fewer people borrowing money on account of the increase in the repayments. The intention behind raising the interest rate is a direct reflection of the use of monetary policy, which aims to impact aggregate demand, employment, and inflation rates within the economy. Utilisation of this policy is aimed at stabilising the economy and relevant business cycles. The recent decrease in unemployment within the Australian economy is one of the main reasons behind utilisation of this policy. According to the Australian Bureau of Statistics, Australia is experiencing the lowest level of unemployment at 3.9%. Whilst technically full employment is achieved when Australia has between 3 and 5% unemployment, if it is too low, it will destabilise the economy. Other details of note include the current level of inflation within the economy, with targeted levels being between 2 and 3%. As at Q1 of 2022, it was 5.1, with this increasing from 3.6 in Q4 of the previous year. As a result of this, the increase of interest rates reflects the use of contractionary monetary policy, with an inflationary gap identified. The gap is symbolised on a demand and supply chart between a leftward shift of the aggregate demand curve, creating a new equilibrium point. Implementation of the contractionary monetary policy would typically take place in the economic period of an ongoing boom period to stop potential downswings and therefore recessions from taking place. The policy is applied to slow down the quickly advancing economy to negate negative effects from taking place. Similar levels of inflation have not been encountered since 2009, just after the GFC took place. This downturn in the economy took place on account of the initial cash surplus offered by their government and in an effort to counteract the downturn in recessions taking place on account of the GFC. The monetary policy is utilised when economies experience larger amounts of aggregate growth and increased amounts of inflation. Consequently, the increase of interest rates is thought to stabilise the amount of growth experienced within the economy, with follow-on impacts indicating that fewer people will be borrowing money on account of the required increase in repayments. Whilst the effect of changing the interest rate and utilisation of monetary policy does not have a major impact on the Commonwealth's spending, it is expected to affect three components of aggregate demand, including consumption, investment, and net exports. As a result of the implementation of the monetary policy, it is expected that the economy will have a reduced amount of spending on the three areas previously identified, with the idea being that people are saving money, with the money supply throughout the economy decreasing. Whilst the rates were amended in May 2022, a change in the economy is not expected to be seen until results are noted within a reduction in economic growth as raised previously, increased amounts of unemployment, and reduced inflation. According to research, it is expected that there is a lag associated with the implementation of this policy, with the RBA indicating that it may take up to 9 months to see a minor impact with a period of up to 2 years potentially required to see the full effects of this policy. The lag in seeing the results from the implementation of the policy is due to processing of the information and, more importantly, an adjustment to the behaviour of businesses and household spending. As a result of the announcement in May, it can be expected that there will be a decrease in the amount of aggregate demand as a result of reduced spending. However, it should be expected to see a surplus in supply for a period, which may have an effect on prices, causing them to drop throughout the economy until the levels of production stabilise and reach a new equilibrium within the market. The increase in rates may have an impact on the current housing price increases as well, with the potential to pop the increasing bubble of the housing market. As a result of this, it can be expected that the prices of houses may proceed to stabilise on account of a decrease or stabilised amounts of demand within the market. This effect can already be seen with housing prices starting to stabilise and experiencing the first price drop since the COVID-19 pandemic commenced, as per the news article published on 1 June. Finally, the increase in interest rates will have an effect on the value of the Australian dollar when being reviewed in an international market. This is likely to be represented by a decrease in imports, however, may mark an increase in demand for exports. The increase in demand for Australian exports may not be as a result of a shift in the demand curve, rather a shift in the supply of goods, with the goods being more expensive to produce at the same level as previously determined. Thank you.